studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Before you can correctly prepare taxes for an owner-managed business, you first need to understand how many small businesses actually operate in the real world. What you see in textbooks is often very different from what you will encounter in practice. Ideally, business and personal finances should be kept completely separate. A corporation should have its own bank account, proper bookkeeping records, and business expenses should be paid only for business purposes. However, the reality is often very different. Many owner-managers use the corporate bank account like a personal wallet. They pay personal credit card bills, transfer money between accounts, keep incomplete records, and assume that because they own the company, every expense is automatically a business expense. This creates one of the biggest challenges for tax professionals. Your job is not simply to prepare a tax return or calculate income tax. Your first responsibility is to identify which transactions belong to the business and which belong to the owner personally. Every transaction should be reviewed carefully. Business purchases, such as inventory, office supplies, or legitimate operating expenses belong in the company's records. Personal shopping, family expenses, vacations, and other personal costs should never be treated as business expenses simply because they were paid from the corporate account. As you review an owner's records, pay special attention to common warning signs. Mixed personal and business finances, corporate credit cards used for personal purchases, poor documentation, shareholder withdrawals, and missing receipts are all indicators that additional analysis will be required before the financial statements can be finalized. Remember that every incorrect classification can affect taxable income, shareholder loan balances, GST or HST reporting, payroll calculations, and ultimately the owner's personal tax liability. The key lesson from this slide is simple but extremely important. Before you think about deductions, tax rates, or tax planning strategies, you must first separate business transactions from personal transactions. Accurate classification is the foundation of good bookkeeping, reliable financial statements, and successful tax preparation. One of the most important skills for a tax preparer is learning to recognize personal transactions that are hidden inside a company's accounting records. These are some of the most common issues you will encounter when working with owner-managed businesses. Many of these transactions begin with money leaving the corporate bank account. At first glance, they may look like ordinary business expenses. However, once you investigate further, you'll often discover that the corporation has actually paid personal expenses on behalf of the owner. A common example is personal credit card payments. An owner may use one credit card for groceries, restaurants, shopping, and business purchases, and then pay the entire balance using corporate funds. Unless you review the individual credit card statements, you cannot determine which expenses are legitimate business costs and which are personal. Mortgage payments are another common issue. If the corporation pays the owner's personal mortgage, the payment is generally considered a personal withdrawal rather than a deductible business expense. The same principle applies to tuition payments for children or family members. Unless the expense is directly related to business training, education costs are usually personal and cannot be deducted by the corporation. You should also pay close attention to everyday shopping expenses. Purchases from grocery stores, retail stores, or furniture stores are sometimes incorrectly recorded under vague accounting categories, such as office expenses or supplies. These descriptions should always prompt additional questions and supporting documentation. Personal loan payments, entertainment expenses, and cash withdrawals also deserve careful review. Some entertainment expenses may qualify if they have a genuine business purpose, but many personal purchases do not. Cash withdrawals often require additional explanation because they frequently become shareholder drawings. When a corporation pays these personal expenses, they generally do not disappear. Instead, they usually become either a shareholder loan or a shareholder benefit. If these amounts are not handled correctly, the Canada Revenue Agency may adjust the company's records and include the value of those benefits in the owner's personal income, resulting in additional taxes, interest, and possibly penalties. As a tax professional, always ask one simple question whenever you review a transaction: who actually benefited from this expense? If the primary benefit belongs to the owner personally rather than the business, it is generally not a deductible business expense. Applying this simple principle consistently will help you identify many of the most common tax issues found in owner-managed corporations. Python 11_re order_playlist.py